Hey everyone, welcome back. You're probably here
Yeah.
because you want to understand what the heck is going on with the Fed,
Mm-hmm.
with the recent interest rate cut, and
Absolutely.
the craziness that's been happening with the stock market. So we are dissecting a CNN article
Okay.
all about this to
Mhm.
try to help us all wrap our heads around this.
Yeah.
It's the December 18th announcement from the Fed, and we're going to be looking at a bunch of things. We're going to be exploring where the U.S. economy stands right now.
Mm-hmm.
We're going to decode why the Fed decided to cut interest rates again.
Right.
And we're going to try to peer into the future a little bit and see what might be coming in 2025
Mm-hmm.
and beyond.
Yeah.
And get this, they're even
Yeah.
talking about something called a soft landing for the
Uh-huh.
economy.
Uh-huh.
Ever heard that?
Oh, yeah.
Don't worry, we'll break it all down for you.
We'll get into that. So this rate cut is it's pretty significant. This is the third time this year
Really?
the Fed has cut interest rates,
Right.
bringing them down to between 4.25% and 4.5%, which is a two-year low.
What?
But here's the thing. It wasn't a unanimous decision. There was one Fed official
Oh,
who actually dissented.
a dissenting voice. I love it when that happens.
Yeah.
Makes you wonder what they're thinking.
It really does.
Right.
Yeah. You know,
What are their concerns?
exactly. It suggests that there's a real debate going on within the Fed. You know, maybe they think the economy's strong enough. And maybe they're worried about inflation
Right.
if we keep cutting rates.
Right.
You know, maybe they're thinking like, hey, hold on a second.
Yeah.
Things are going pretty well right now. Do we really need to keep pushing this?
Well, and the article does mention that the Fed is always trying to find that balance, right?
Right.
Between encouraging economic growth and keeping inflation in check.
Absolutely. That's their mandate. That's the tightrope they're
Oh.
always walking.
Yeah, sounds like a tough job.
It is. It's a tough job. And speaking of inflation, that's really what this is all about. Remember, the Fed, they're aiming for about 2% inflation.
Right.
And we're still higher than that, which is why, they're signaling a more cautious approach to rate cuts in 2025.
Okay.
So initially they projected 4 cuts, but now it looks like it'll only be 2.
Interesting.
So that's something to keep an eye on as we're looking ahead.
Okay, fewer rate cuts. So they're feeling more confident about getting inflation under control.
Yeah, perhaps they're signaling that.
But then why did the stock market freak out?
Yeah,
The article says the Dow dropped over 1,000 points.
right.
Doesn't really sound like good news to me.
Yeah, that was pretty surprising, wasn't it? I mean, usually a rate cut is welcomed by the markets, but it seems like they were hoping for something even more aggressive.
Oh.
So this just goes to show how complex the relationship can be between the Fed's actions and how the market reacts. Sometimes the markets react more to what they expected the Fed to do, rather than what actually happened.
So it's not just about the numbers. It's about expectations
Yeah, there's definitely a psychological element at play.
in psychology. Wow, fascinating. But here's what I'm really curious about. The article mentions the U.S. economy is actually doing surprisingly well at the moment.
That's right.
Even Jerome Powell himself, the Fed chair, talked about the economy's remarkable resilience this past year. Help me out here. A strong economy, is that actually a bad thing?
It's not necessarily a bad thing, but it does complicate things a bit. You see the economy's strength, particularly with things like consumer spending and business investment, gives the Fed more leeway to slow down those rate cuts because they're seeing the economy hold steady. So they're being a little bit more measured in their approach. It's like they're saying, hey, things are going pretty well. Let's not rock the boat too much.
Interesting. Okay, so a strong economy means they can be more cautious with rate cuts,
Yeah, that's one way to interpret it.
which maybe explains why the stock market had a bit of a tantrum.
Right, exactly.
They were expecting more drastic action.
They were maybe hoping for a bigger cut.
Okay, I'm starting to see the pieces fit together here. But speaking of economic scenarios, this article keeps mentioning something called a soft landing.
Okay.
I have to admit, I'm not entirely sure what that means.
Yeah, it's a term you hear thrown around a lot. Can you break it down for us? And why should we care?
Yeah, what is this soft landing thing?
So a soft landing is kind of like the holy grail of economics. It's this rare scenario where you manage to bring inflation under control without triggering a recession. So it's essentially like gently tapping the brakes on the economy and letting it slow down gradually instead of slamming on the brakes and causing a crash.
Oh.
And some experts actually think we might already be in the early stages of a soft landing right now.
Wow. A soft landing. Okay, now that does sound promising. So if this is really happening, what would that actually look like
Yeah.
for everyday people like you listening right now?
Well, imagine a world where businesses keep investing, creating jobs, and expanding. The economy keeps growing at a healthy rate, but without setting off alarm bells on the inflation front. So prices stabilize, they become more predictable,
Yeah.
which makes it easier to budget and plan for the future.
Okay.
And hopefully, wages rise in line with the cost of living, so people can maintain their standard of living. That's really the beauty of a soft landing. It's about achieving stability and long-term growth instead of these boom and bust cycles that we've seen in the past.
I like that, a gentle tap on the brakes instead of a full-on stop.
Exactly.
Sounds ideal. But hold on. The article also mentions that the Fed doesn't expect inflation to hit their 2% target until 2027.
Yeah.
That's a whole year later
Mhm.
than they initially predicted.
That's right.
So what's the story there? Are these persistent inflationary pressures kind of working against this whole soft landing idea?
It does suggest that inflation is a little bit stickier than they anticipated. I mean, there's a lot of factors at play here. Global economic conditions are always a bit of a wild card. And then there's the whole question of the incoming Trump administration
Right.
and their policy plans. So, tax cuts and deregulation, they could potentially stimulate growth, but tariffs, especially those targeting Mexico, Canada, and China, could potentially fuel inflation, which makes the Fed's job a lot harder.
Okay, so navigating those policy impacts is going to be a delicate dance for the Fed.
Yeah, it's like trying to walk a tightrope while juggling chainsaws.
Exactly. But for now, they seem to be taking a wait-and-see approach. So should we be doing the same?
I think that's a good idea. I mean,
What steps can we as individuals take to be prepared for whatever economic surprises 2025 might have in store?
that's a great question, and it's an important one to think about. Well, a good place to start might be to review your budget.
Okay.
Do you know where your money is going each month? Are there any areas where you could cut back or maybe save a little bit more?
Okay, so classic budgeting advice.
Yeah,
But always good to have a reminder, right?
absolutely.
Especially when things feel a little bit shaky out there.
It's always good to have a solid foundation. And another key step is to make sure you have an emergency fund in place.
Oh, yeah. That's a good one.
Ideally, you want enough savings to cover 3 to 6 months of living expenses.
Wow.
This can provide a crucial safety net if you encounter any unexpected financial challenges, like a job loss
Oh, yeah.
or maybe a major medical expense.
Okay, that emergency fund is like a financial security blanket, right?
It is. It is.
Just knowing you've got that cushion can make a huge difference.
Absolutely.
Just for your peace of mind.
It gives you that sense of security. And while we're on the topic of financial security, let's talk about investing.
Oh,
Diversifying your investments is another smart move,
right.
especially during uncertain times.
Right.
The old saying, don't put all your eggs in one basket.
So spreading your investments across different asset classes.
Yeah, that's exactly right.
Stocks, bonds, real estate, maybe even some alternative investments.
Exactly, precisely. Diversification helps to mitigate risk. If one sector of the market takes a hit, your entire portfolio won't be wiped out.
Oh, that's a good point.
It's about balancing risk and reward.
It all comes back to that doesn't put all your eggs in one basket.
Yeah.
Smart advice.
Yeah.
No matter what the economy is doing.
It's a timeless principle.
But let's get back to those potential policy changes coming from the new administration,
Right.
tax cuts, deregulation,
Yeah.
and those potentially inflationary tariffs. That's a lot for the Fed to juggle.
Yeah, there's a lot on their plate.
Can you walk us through some potential scenarios here?
Sure.
What could those policy changes mean for the economy?
Yeah.
And, more importantly, for our wallets.
So let's start with tax cuts.
Okay.
If the Trump administration pushes through significant tax cuts, that could provide a short-term boost to the economy.
Okay.
People would have more disposable income,
Okay.
which could lead to increased consumer spending, which could stimulate growth.
Sounds good on paper, right?
Yeah, in theory.
More money in people's pockets, more spending, more economic activity. But is it really that simple?
Well, it's never quite that simple. Tax cuts can also lead to larger budget deficits, which could have negative consequences down the road.
Okay.
And if those tax cuts are poorly designed or implemented, they might not actually stimulate the economy as intended.
Right. So you got to consider those long-term implications.
Absolutely. You got to think long.
Okay, what about deregulation?
Okay.
The article mentions that as a potential growth driver as well.
Yeah, deregulation can definitely reduce costs for businesses, which in turn can lead to increased investment and job creation. But here's the catch. Deregulation can also come with risks. If you roll back regulations too aggressively, you might end up sacrificing important consumer protections. or environmental safeguards.
Yeah, you don't want to throw the baby out with the bathwater, right?
Exactly. It's all about finding that balance between promoting economic activity and protecting the public interest.
A delicate balance indeed.
It is.
Okay, now for the big one. Those tariffs.
Oh, okay.
The article suggests they could be a major wild card in the economic outlook,
Yeah.
potentially driving up inflation.
Yeah, tariffs can be a bit tricky.
Walk us through that. How could tariffs impact prices
Yeah.
and ultimately affect our wallets?
So tariffs essentially make imported goods more expensive.
Okay.
So let's say you're a business that relies on imported parts or materials. If those tariffs kick in, your costs go up, and you're likely to pass those increased costs on to consumers in the form of higher prices.
Okay, so classic supply and demand, right?
Yeah, that's the basic principle.
Increase the cost of goods.
Yeah,
And prices go up.
exactly.
And if prices go up across the board, that's when we start talking about inflation, right?
Exactly. That's when inflation becomes a real concern. And if inflation starts to rise too quickly, it can erode the purchasing power of our money. It means your paycheck doesn't stretch as far, and your savings lose value over time.
Now, those tariffs could be a double whammy,
Yeah, they could have a ripple effect.
potentially hurting the economy by increasing costs for businesses and also squeezing consumers with higher prices.
Right. It's a potential lose-lose situation.
Not exactly a recipe for a soft landing, is it?
It definitely complicates the picture. The Fed will have to weigh those potential inflationary pressures against the potential growth benefits of tax cuts and deregulation. It's going to be a delicate balancing act.
Sounds like we're heading into uncharted territory here.
Yeah, there's a lot of uncertainty ahead.
With this mix of policy changes
Yeah.
and economic forces swirling around. But even amidst all this uncertainty, there are things we can do right
Absolutely.
to take control of our own financial well-being.
Yes, there are always steps you can take to empower yourself.
Yeah, absolutely. There are a lot of things we can do. We've already talked about budgeting,
Right.
building an emergency fund, and diversifying your investments.
Yeah.
But there's another crucial step you can take.
Okay, what's that?
Stay informed.
Okay, that's a big one. But how do we do that in this age of information overload, right?
Yeah, you're absolutely right.
Yeah. How do we even begin to stay informed
Right.
about something as complex as the economy? It can feel overwhelming.
There is so much information out there, it's easy to get lost in it all. But here's the thing. You don't have to become an economics expert overnight.
Right.
Start by finding reliable sources of information that you trust.
Okay.
There are great podcasts out there, websites, even newsletters
Right.
that break down economic news in a way that's clear and accessible.
So it's about curating our information
Right.
sources, right?
These
Finding
seem-
those voices that resonate with us and
Yeah.
explain things in a way that we can actually understand.
Absolutely.
Okay, and then what? Do we just keep absorbing information?
Right, that's the next
How do
piece.
we actually apply that knowledge to our own lives?
That's the key, right? It's
Yeah.
not just about passively consuming information, it's about actively engaging with it.
Okay.
So once you have a basic understanding
Mm-hmm.
of the economic forces that are at play, you can start thinking about how those forces might impact your own financial situation. Okay, so let's get specific. What are some questions we should be asking ourselves
Okay.
as we try to connect these broader economic trends to our own personal finances?
Well, for starters, you could ask yourself, how might these potential tax cuts affect my own tax liability?
Okay.
Or, if inflation starts to rise, how will that impact my budget? How will that impact my savings?
Right.
And with the possibility of tariffs looming, think about, are there any goods or services that I regularly purchase that could be affected by price increases?
I love that. So it's about connecting those big picture economic headlines
Yeah,
to our own personal financial reality.
exactly.
It's not just letting those news stories kind of wash over us,
Yeah.
but actually taking the time to think, okay, how does this actually impact MEE? What adjustments might I need to make?
Precisely. It's about being proactive
Mhm.
and taking ownership of your financial well-being.
Okay.
And here's another thought. Don't be afraid to seek out professional advice.
Well, that's a good point.
Yeah.
Sometimes it's really helpful to have an objective perspective, right?
Abs-
Someone who can look at your situation and offer tailored guidance.
Exactly. A financial advisor can help you develop a personalized financial plan that aligns with your goals and your risk tolerance. They can help you navigate those complex investment decisions and make sure that you're properly diversified.
So it's like having a financial coach in your corner.
It is.
Someone to guide you and answer those questions. That might feel a little overwhelming.
Exactly, and bounce ideas off of.
I like that.
All right.
Okay, so we've covered a lot of ground today.
We have.
From the Fed's latest rate cut
Uh-huh.
and the surprisingly strong economy
Mm.
to the potential impact of Trump's policies.
Mm-hmm.
And that elusive soft landing, it's a lot to process.
It is a lot.
So let's try to distill it down to some key takeaways here.
Okay.
What are the big things
Yeah.
we want our listeners to walk away with?
Well, I think the first and foremost thing to remember is that the economic landscape is constantly evolving.
Right.
There will always be uncertainty, and there's no way to predict the future perfectly. But that doesn't mean we should just throw up our hands and give up. The more informed we are, the better equipped we'll be to make sound financial decisions.
Right. Knowledge is power.
Absolutely.
So even though the future might feel a bit murky,
Mm-hmm.
we're not just helpless passengers along for the ride. We can be active participants in shaping our own financial futures.
That's the key takeaway here. You have the power to shape your own destiny.
I like that. What else? Anything else we should be keeping top of mind?
Don't forget about that emergency fund. Having that financial cushion can make a world of difference if you face unexpected challenges.
Right, a financial security blanket.
Exactly.
Okay, so we've got knowledge, we've got diversification, and a healthy dose of preparedness. I'm feeling empowered already.
That's great.
But before we wrap up, I want to touch on something that really struck me in this article.
Okay.
The Fed is taking a wait-and-see approach right now.
Mm-hmm.
They're carefully monitoring the economic landscape, and they're ready to adjust course if needed. And the new administration is about to unveil its full economic agenda. So much is still in flux.
A lot of moving parts.
Given all that, what's the one question we want our listeners pondering as they go about their day?
Here's what I'd leave you with. With so much change on the horizon, both in terms of policy and economic forces, what opportunities and challenges do you see emerging? And what can you do to prepare and position yourself for whatever comes next?
Beautifully put. So it's all about staying engaged, keeping those questions top of mind, and never losing that sense of curiosity. So on that note of empowered curiosity, we'll wrap up this deep dive.
Thanks for joining us. Until next time, keep exploring, keep learning. And remember, knowledge is power.